Good afternoon, this is Todd Colvin coming to you from the floor of the CME Group. We are looking at rates, and while we did see a modest pullback in 10-year note yields from the highs on Friday, continued on Monday, doesn't mean we're ending the recent streak of yields trending higher. It's just right now kind of seeing a moment of pause. We're seeing the market kind of gather itself, but I think these pullbacks are going to be less and less important unless we break through key levels, unless we get south of 3% again, which doesn't look like we're going to do. I think we reascend back towards 3.25, which will ultimately be the target, I think, ahead of June FOMC. And as you can imagine, market volatility, while we stay inside that range, inside that area of comfort, continues to decline. We peaked just middle of last week, and we've seen slight declines to modest declines end of last week and into today. Nothing has really changed. We stay inside that comfort zone. Everything in volatility world should continue to point lower. However, if we make another new high yield mark, we'll be outside of expectations. Likewise, we should see things kind of firm up a little bit. And lastly, what could be the cause or the catalyst for something? Well, we've got the 3 Treasury auctions, 2s, 5s, and 7s this week. That is always interesting to see how the market prices in, especially when you see yields much higher than the previous month. And secondly, the May FOMC minutes, which typically the minutes have been a bastion of volatility in itself, typically higher than the actual meeting. And especially on a meeting where there wasn't a press conference or any sort of forward guidance, just a regular old meeting with a statement. And the markets didn't really over or under react after. It took about 2 weeks for the market to start to see yields move sharply higher. So right now, maybe getting a look under the hood is something that the market wants. How quickly will the Fed start raising rates in the second half of the year into 2019, or are they just going to kind of let the numbers play? And if things are really aggressive, things are very high inflation, low unemployment, mediocre growth, will they continue to raise rates at the pace that the market is expecting? It'll be very interesting to see, and the minutes typically give us at least a window to that. So right now, 10-year notes still spinning their tires as we await the auctions, as we await FOMC, and at the end of the week we get durable goods into the holiday weekend here in the U.S. This is Todd Colvin coming to you from the floor of the CME Group.